Hello, everybody. This is Justin Rekla with Cryptocurrency, CryptoBit Verified, Cryptocurrency Due Diligence, and we are talking with Elmer Howard today. Elmer is a vital part of our due diligence team, and we're talking about cryptocurrency taxes. A lot of people don't realize that when you generate income from cryptocurrency, you need to report it. You need to pay your fair share of taxes, and otherwise it comes with some hefty penalties. If you do not, again, depending on what part of the globe you're in, this may apply to you, it may not, but here in the United States, it is an issue. I think one of the conversations that Elmer and I first had around cryptocurrency due diligence and taxation of cryptocurrency was the sheer fact that in 2016, of everybody in the United States that had utilized or received gains from cryptocurrency, only I think 5%, Elmer, had really 5% had actually reported capital gains on their income tax. And as the popularity of cryptocurrency increases, this is going to become a problem for those that are in the United States. And so one of the reasons why I love having Elmer on board and part of our team is the fact that he is our resident cryptocurrency tax expert and how to account for it, what to do with it, what not to do with it, what to report, when to report, and so forth. So he's put together a presentation here. So I'm going to turn it over to him so he can get going with the presentation. During the presentation, any point in time, if you have any questions, make sure you chime in the comment section, of the question section. I'll be monitoring that so I can answer those questions for Elmer as he's going through things. And before we get started, Elmer, first off, thank you for joining us here.
Well, thank you. Thank you for having me.
Awesome. And so you're with Dollars Sense Bookkeeping. Can you share a little bit about where people can go find you before we dive into the meat and potatoes of this?
Yeah, the easiest way to find me is on the website. It's D&S Bookkeeping, so it's DANDS, so like Dollars and Cents, bookkeeping.com. You can also look up Dollars and Cents. It's an ampersand, Dollars and Cents Bookkeeping for like Facebook. We have a Facebook page as well.
Fantastic. And if you're not finding him there, he is part of our cryptocurrency due diligence group on Facebook. You can connect with them there as well. And he's also, it's one of the things I love, is he's also in the Clear Business Directory. He has been fully vetted. He is a fully vetted member of the team. So we're super excited to have him here with you. With that, Elmer, I am going to turn it over to you. So you're up.
Okay, I'll share my screen and start this presentation. Nope. Sorry. There we go. All right, cryptocurrency accounting. First off, I do want to go over the legal pieces.
Yeah, real quick, I do want to put that out. Just so you know, Elmer and I are not financial advisors. So Elmer is a bookkeeper, does accounting, and he is helping people with cryptocurrency accounting. So just legal disclaimer here, make sure you read this. Again, we are not financial advisors. This is for information purposes only. Should you seek assistance or need assistance with your cryptocurrency accounting, please feel free to reach out to Elmer after the presentation.
And as we know, tax laws do change pretty constantly, and IRS still has a lot of notices probably to put out and comments to make about cryptocurrency in general. So, what I present today could be, false tomorrow, depending on any current changes. So, IRS treatment of cryptocurrencies. In 2014, the IRS released their notice and decided that the IRS said that they're going to use crypto as property. Which means you have short-term and long-term gains on the sale of that asset. And that depends on what determines whether it's a short-term or long-term gain, depends on how long you've held the property. People think it's just 1 year, but it's actually technically 1 year and 1 day. So if you held a piece of property for 365 days, it's still considered a short-term. And the difference in taxes is pretty great. Short-term taxes are considered part of your income. So whatever your income rate is at that time, that's what your short-term gains will be taxed on, where long-term gains are more of an investment type of gain. So you're looking at more of the 15% tax rate for that. People talked about the 26, the Title 26 of the U.S. Code, the 1031 exchanges. Before 2018, people were trying to use that and potentially getting away with it. The IRS never really made any statements about that. However, with the new tax law of 2018, the bill that was passed by this Congress, they decided that the 1031 exchange will only work on actual real property, as in real estate property. So even before, you could use it on a car. If you bought, now it had to be the same. If you had a car and you sold it and bought another car of the same, same type, not from a car to a truck or a car to a motorcycle, you could use that 1031 exchange. So people were saying, well, what if we did it with coins? And the government decided that they were going to just say no to that and actually limit it all around to just for real estates. Losses can offset gains and other income up to $3,000 per year, and these unused losses can be carried forward. A little extra note on that. So when you have losses on your gains, they have to go towards the gains first, and they actually have to go towards the gains that the losses were a part of. So if you had losses in long-term gains, that has to offset gains in the long term before it can be applied to any short-term gains. After you've used all that up, if you have no more, gains to offset with losses, you are able to offset up to $3,000 against other kinds of income, including your salary and interest income. And then these can be carried forward over subsequent years to be deducted against capital gains and against up to $3,000 of other kinds of income. If you're married, filing separately, the status is limited to only $1,500. Again, this is a good place, definitely, if you have losses and you want to figure out how to use them, talk to your accountant, as everybody's particular situation is going to be unique and different. So when you're dealing with how to track your gains and your losses in cryptocurrency, you have to choose your cost basis and your inventory method. Technically, cost basis is daily, so you can take the high of the day, the low of the day, or even the average of the day. However, in most software that you use, I know Bitcoin.tax that I use does this. It actually gets the timestamp from the exchange, so it knows its price exactly when you bought or sold it. And if you're dealing with thousands of transactions, even though it might be beneficial over time to say I want to choose the high or low of the day, it's just a lot of work to be doing each individual transaction to figure out which one you want to choose. In terms of inventory methods, just like regular property, you have how they're treated when they come in and out. You have LIFO, FIFO, and others. LIFO is last in, first out. FIFO is first in, first out. Anybody in the restaurant industry knows FIFO. First in, first out is the first product that goes into the refrigerator is the first product that should get used when it comes time to using it, not the stuff that comes in last, because obviously the stuff that's older is going to spoil faster. Same kind of concept. The FIFO is the first coin you bought, is the first coin you sold, not the most recent coin. And so depending on your situation, your tax situation personally, the taxes and gains that you have on the cryptocurrency, and even what you plan to do in the future. I have a client who had a lot of cryptocurrency, and we were trying to figure out, which was the best inventory method to choose. And we looked, and I told them, let's not just choose the one that's best for this year, because moving forward, it might not be best in further years, and you might have a momentary, gain of not paying taxes, but it's going to hurt you over the next, however long you hold on to these cryptocurrencies, because the inventory method is going to affect that differently. We were able to run some numbers through Bitcoin.tax and found out that what we thought was the best, in the moment was not best for the long term. So we had to change, how we were going to treat their cryptocurrency in terms of their inventory method to get them the best long-term situation for their taxes. Paying for services, employees, wages. People wonder if I have an employee and I pay them with cryptocurrency, do I have to deal with anything that deals with like current wages or 1099s? And the answer is yes. It is considered a form of payment, and it has to be treated like regular wages. If you have an employee that you're paying in cryptocurrency, you have to withhold the taxes for them, just like you would if you were paying them a paycheck. If you issue 1099, obviously to anyone who makes over $600 in a year that isn't a salaried employee, or even an hourly employee, but you're paying them for contract work. Once they hit the $600 in in a year, calendar year, you have to 1099 them, even if you're paying them in cryptocurrency and in mixture. If you pay them $500 in cryptocurrency and $200 in cash, that's $700 for the year. It doesn't matter what kind of form of payment it was. You have to give them a 1099. This is also subject to backup tax withholding when it comes to 1099 contractors. Justin, did you say something?
Yes, I just had a question that came in while we're here. One of the questions that just came in said that if they took Bitcoin out of Coinbase and put that into an opportunity, but they then took that, they only took out $2,000 from that opportunity, they only had to be concerned about reporting the gains from the initial $2,000 that was put back into their bank account. Is that correct?
So yeah, correct. So your cost basis, anything over or under your cost basis at the time you sell it is what you got to worry about. So if you had $2,000 worth of Bitcoin, you put it into an opportunity, and then $2,000 came back from that opportunity, you're break even. It's a wash. It's a 0-0. But if you put in 2,000 and you brought back 2,500, you have $500 in gains. So it's whatever is above or below your cost basis is what you have to report in terms of taxes. I hope that answers that question.
Perfect.
Follow-up, just let me know.
Will do.
So the subject to back up with tax withholding, the same thing with any 1099 contractor. If for some reason they don't want to fill out the W-9 form giving you their tax information so that you can report the 1099 to the IRS, then by law you have to withhold. It's like 28 something percent. I always tell people 29%. You have to withhold 29% of their payment if you know they're going to go over 600 and they're refusing to fill out the form, because then the IRS considers you responsible to pay their taxes. Tax fraud is what Justin was talking about early on in the conversation. So the IRS, back in March, it's probably higher now. They had over 13,000 Coinbase account holders who bought, sold, sent, or received digital currency worth 20,000 or more between 2013 and 2015. And recently, I didn't get a chance to look it up. I don't know if it's Bitstamp. There's one other company out there who has actually decided to voluntarily start giving the IRS their user information. So, if don't think that the IRS isn't going to know about this, they will, which comes to my second point here, which is cryptocurrencies are not anonymous. At best, they're pseudonymous. I have a hard time with this word.
Pseudonymous?
Anonymous, pseudonymous. Yeah. Anyway, like a pseudonym, when you have writing under a different name, people aren't going to know who you are unless somebody can make that connection. And cryptocurrencies are the same way. You're on some exchange. Nobody knows who you are because you're some email or you're some wallet ID. But the second anybody can figure out who you are, the anonymity is gone, and the IRS is going to know exactly what you have in your.
Absolutely. Just to plus that, one of the things that we tell people all the time is if you're registering, if you're buying on an exchange, and you have to go through a KYC process where you have to verify your identity, your address, your picture, your phone number, all that kind of stuff. Because of blockchain, the transparency piece is gone. So if you move money from your exchange to a wallet address, that wallet address can be associated with you. So the anonymity that comes from cryptocurrency for anything that's done through an exchange is very difficult to get around. And for tax reporting purposes, that's extremely important if you are transacting through the exchanges.
And just like hiding money offshore, people think like, well, the IRS doesn't have any jurisdiction over these banks. But, as we saw in the Panama Papers and other instances, even in Europe, that, the IRS, the governments can find ways, can convince banks, and in this case, exchanges to turn over the data they have. So, yeah, it's not truly anonymous as there is something linking you to it. And all it takes is somebody to find that to associate these accounts with you. And now in terms of tax fraud, that occurs when there's a willful or intentional falsification of information on a tax return to avoid taxes, in layman's terms, underreporting, your income. And these civil penalties, civil penalties for this include a fine of up to 75% of the owed taxes. So if, you underreported, $100,000 and the IRS says that you owe $10,000 in taxes, they could charge you $17,500 for the $10,000 you owe plus $7,500 in the fine. Now, when you get into the criminal, and considering what Justin said earlier, that there were almost hundreds of thousands of users were using Bitcoin, were using cryptocurrency, and a very, very small percentage over those few years were actually reporting it. The IRS is just not taking this lightly. And so most likely the first person who was caught, with a big amount of cryptocurrency they didn't report, it's probably not going to be civil. It's probably going to be criminal, because they're going to want to send a message. And in that case, the criminal penalties range from $100,000 to $500,000. That depends on if you're doing it in your own name, it's a $100,000 fine. If you're doing it through a business name, it's a $500,000 fine, and both carry 5 years in federal prison. If anybody on this call listening to this webinar now or in the future has any past dealings not reported to the IRS, you need to speak to a tax attorney. The reason I say speak to a tax attorney and not to someone like me as an accountant is I don't have the client privilege that attorneys have. Client attorney privilege that they have. If the IRS, if you were to tell me that you had holdings overseas worth whatever and you weren't reporting it, and we didn't report it, and the IRS found out about it, they could subpoena me, and I have to testify against you. I have no protections, and I'm not going to go to jail for somebody else. So in this case, it's better to speak to a tax attorney, because they have that client attorney privilege. They can tell you how to deal with it, and whether or not maybe you should, it's so small not to report it. But at the end of the day, no matter what they tell you to do and what you do, if they get subpoenaed because you have attorney-client privilege, they can't divulge any information that you divulge to them. There's a statute of limitations when it comes to how far back the IRS can audit you. Currently, it's 3 years after return's due date to assess penalties. However, that expands to 6 years if income is understated by more than 25%. This depends on the due date of the. Some of the exceptions are like when the return is filed. So just because if you didn't file in 2014 and you're thinking I'm going to file in 2018 for the 2014 year, I'm past the 3-year mark. Well, no, technically it doesn't count that way. It starts running when the return is filed. So then they have 3 years from 2018 to audit that return, because the 3 years starts when it is filed. Now, if fraud is perpetrated, if they think that, whether it's civil or criminal, if you've underreported income in a fraudulent way, and the difference between the fraud and the whether or not it's just a mistake or oversight, is that intentional? If you know for a fact that you have cryptocurrencies, you know for a fact that you have to report your gains and you choose not to, that is fraud. And so if they find that you have committed fraud, then there is no time limit on reviewing your tax returns. In essence, the IRS can review every tax year of your adult life. In the next 5 to 10 years, you're not going to be doing anything but dealing with the IRS. Besides sitting in jail for the 5 years. I guess it gives you the 5 years time to deal with and figuring out the IRS auditing the rest of your tax returns over your life.
Not fun.
No. So some other FAQs I get. Do I have to pay taxes when I receive new coin from a fork? Yes, that is considered other income. There was some debate, and maybe currently still is, where like if somebody purchased a cow that they knew was pregnant, then their cost basis is divided between the cow and the calf, so that when you buy when you use whatever they sold the cow for, you don't have to pay taxes when the calf is born, because they counted that as part of that initial purchase. The problem is the farmer had to know he was buying a pregnant cow to have that delineation in taxes. There's an argument of we always assume cryptocurrency is going to fork and split. Well, you really don't know, and so it'd be hard to argue that if unless you saw something coming out months ahead of time and you decided to buy a big chunk of cryptocurrency because you knew there was going to be a fork, then you could potentially argue that part of your cost basis then is to be applied towards that fork. Otherwise, you treat the fork as the value that you receive it. So if when Bitcoin broke off to Bitcoin Cash, whatever you received in Bitcoin Cash, whatever the value was, that is considered other income. It goes on your tax return on the 1040 under other income. And then that's your cost basis. So then when you sell or exchange that down the road, you do have a tax consequence. I didn't cover this earlier. People wonder about tax consequences in terms of When do you have a tax consequence? So in terms of cryptocurrencies, the tax consequence happens whenever you sell or exchange a cryptocurrency. Sell it, obviously, back to any fiat currency. Exchange it. People were wondering about exchanging, between like Litecoin and Bitcoin, whether or not that was taxable. And before the 2018 bill, it was arguable that you were doing a 1031 exchange. Although technically, it's not. It's a like kind, but it really isn't. It's a difference. And like, you couldn't take a car, sell that, and then buy a truck and say that you're exchanging it, because even though they're both automobiles, they're different kinds of automobiles. And so the coins, could have been argued. Again, now that 2018's happened, it doesn't really matter. So if you have, any exchanges from Bitcoin, Litecoin, or any other cryptocurrency, that does create a taxable event. You have a gain or a loss that you have to track. I use Bitcoin.tax. It's been wonderful for my clients in determining what their cost basis is, determining what their profit and the gains or losses are, and figuring out the taxes.
Perfect. So quick question. One that pertains to the topic they're running right now, and then I want to go back and ask another question that somebody chimed in with. So just for clarification, until you sell Bitcoin Cash, there is no tax event. So for instance, if somebody had Bitcoin and then when Bitcoin forked into Bitcoin Cash, there's no tax event created from that fork until Bitcoin Cash is converted back to US dollars.
No, you actually have two taxable events. When you receive the Bitcoin Cash, you had income. That's considered income that's taxable. So you're if you received one Bitcoin Cash, it was worth $1,000, then you got $1,000 in income. And you have to report that $1,000 as income. When you do something with that Bitcoin Cash, if you exchange it to a Bitcoin or Litecoin or whatever, or sell it back to fiat, then you have your capital gain or loss that creates a taxable event as well.
Perfect. Awesome. And then the second question that came in prior to that was, is there any benefit to buying gold or silver with cryptocurrency from a tax perspective?
No, it's an investment. It's just like buying a house. If I wanted to buy an investment property that was a house, using the cryptocurrency is just a medium of exchange. You can't get the 1031 exchange on it. You have a taxable event at that point. It's going to be a little different because you're changing like one property for another property, but you're going to still have the capital gains. It's just like if you took the money, turned it into cash, and bought the house. That turning the cryptocurrency into cash you have a capital gain or loss on that, and then you buy the house. And it's the same thing when you exchange the house, the cryptocurrency for the house. Whatever that value of that house is what is now what the value of the cryptocurrency is, and depending on your cost basis, you're going to have a gain or a loss when you purchase that house. Perfect. That makes sense. So awesome. So with that, I think you were getting ready to go into some of the other areas. A few more of the FAQs to cover real quick. Some people ask, why does the IRS not treat cryptocurrency as a legal tender? Because legal tender in the United States is only created by the government in terms of, they create the currency, they own the currency in terms of our dollars and cents. It's the United States system, they own it. Cryptocurrency isn't owned by anybody, or it's not supposed to be. It's supposed to be decentralized, and therefore it's not going to be considered a currency. And it's not considered legal tender in the United States because of that. It's considered kind of a currency. It's considered cryptocurrency. It's not considered legal tender for the U.S. Of course, they are talking about creating their own cryptocurrency at that point. If they came out with a U.S. crypto coin, that would be legal tender in the U.S. because the United States government is creating it.
Perfect. And just to reiterate that's one of the biggest issues that we're seeing in from all the regulatory agencies right now is just that. The IRS is treating it like a property. The Commodities Exchange Commission says it's a commodity. Securities, the SEC basically comes out and says that ICOs are securities. Yep. There's a lot of what to do with it perspective. Really, at the end of the day, I think the IRS may end up winning out because they're the ones that collect the money for the government.
Yeah, in terms of taxes, they're the last statement when it comes to how it's being treated. If you're involved with an ICO and a company is doing an ICO, obviously you should make sure you're not gonna cross the SEC. And unless you're on Forex, I guess. I don't know if that make a difference about whether or not you're using it as a currency. I don't know much about the Forex. Another question that I get is, what about cryptocurrency that was stolen? Or more recently, a lot of people have asked me, well, I lost this, I don't have access to it, or the company disappeared, or the wallet disappeared, or whatever it is. In those cases, they are considered a loss. Again, you can only do up to $3,000 per year, but you can roll that forward, and that would go against your gains first. You offset your gains before you can take whatever's left over from the 3,000 and apply it towards your gains, and apply it towards like your income.
Awesome. That's going to be these folks. This is why I love having Elmer on the team, because I've lost more money in the name of due diligence in the cryptocurrency world than most, because I like to dive in and test things out to make sure that they are actually working. So it's nice to know that I get to write that off as a business expense.
Yeah. Yep. Yeah, and you get to claim the gains on your taxes as well. And another question: are mining earnings taxable? Yes. This kind of goes back to like the fork. When you get earnings again above and beyond your initial investment. So if I put $2,000 in to a mining operation, the first $2,000 that I get back is not a taxable event. I'm just getting back my initial $2,000, and then anything over that is considered income. So you will pay taxes on that income at the end of the year. And then, of course, you've created new coin with a new, again, when you get it, is the cost basis, whatever that day is, not based upon the cost basis of what you've put in. When you get back to 2,000, that's obviously dealing with the cost basis. You bought the 2,000, but everything above and beyond the 2,000, when you get it, the cost basis is that day, or if you're using an exchange, it's going to be that minute that you exchange it. And then you have another taxable event down the road. You now have this extra coin that you've created or mined, been paid for, invested in, whatever it's come back as, after you've paid the income on, recorded the income on that. When you exchange or sell that cryptocurrency, you again have a taxable event if you have a gain or a loss.
Fantastic. So just to clarify, I had a question come in. So just to clarify on that $3,000 limit, let's say, for example, somebody invested $10,000 into an ICO, and that ICO folds, it goes under, nothing ever comes of it. Is that, let's say that $10,000 that was put into that, is that $10,000 counted for a loss in a single year, or is only 3,000 of it counted as a loss for this year, and then the other 7,000 is rolled out and distributed in $3,000 chunks down the road?
Yeah, it has to be only $3,000, and you can roll forward anything that's over that. So yes, you use the $3,000 to offset this year, and then you can keep using the $3,000 moving forward. That's why, if anyone's been watching Trump closely, which I don't know anybody would, he talks about he hasn't paid taxes in 30, 40, 50 years, whatever it's been. And it's because of the same concept. He has a $10 million loss. He just keeps moving it forward and never has to pay taxes because he's got forever basically to use these losses. And that obviously is a little different. Some places you're going to use losses for so long. I believe with deductions, I don't believe there's a limit, but don't quote me on that. Make sure you're asking your accountant, like, hey, how much of this can I use each year? And don't plan on having a lot of losses if you're only allowed to use it for 3 or 4 years before you lose it all. But I think in cryptocurrency, there's not. It's business losses that have a limit to it, where cryptocurrency is a little different.
Perfect. I love that from a risk mitigation standpoint, that really empowers people that are investing in the cryptocurrency space, knowing that if it doesn't take off, it doesn't moon, it doesn't make it, then by all means, you at least have the opportunity to write off a portion of it each year, and that you can carry that forward. I absolutely love that. Elmer, if you don't mind, can you make me host again so I can start?
Just did. You should be the host now.
Perfect. My camera should be starting. So with that, everybody, thank you so much. This is what, again, one of the reasons why I love having Elmer a part of the team, because he is extremely knowledgeable about the cryptocurrency space. The other thing I love about having Elmer a part of the team is he's going to paint it out for you. He's going to paint the picture, show you what it's like, because he himself is a business owner and he understands the ins and outs, the gray areas, the black and the white, so you can make educated decisions on what to do, how to write things off, on how to mitigate your risk. in the cryptocurrency space. As you can see, there's lots of things to cover. The accounting aspect of it can be a little technical, a little time consuming. Elmer and I have sit down on multiple occasions and gone over the accounting that is involved for keeping track of your cryptocurrency transactions. But the beautiful thing is that's what Elmer does. So if you have any questions, feel free to reach out to Elmer here in the group here. Or again, Elmer, what's your website?
It's DNSbookkeeping.com, Dollars and Sense Bookkeeping, DANDS, spells Dan's, bookkeeping.com. And they can email me at elmer@dnsbookkeeping.com.
Fantastic. I do have a last question that just came in. So what's the best way to find an accountant that knows crypto in the person's geographic area? Is there a site that somebody can tap into?
And in terms, if you want someone geographical, then I can tell you where to go. Just so you know, I've worked with people from all across the United States, South Africa, and Thailand in dealing with their cryptocurrencies. If you're looking for anybody, obviously, it's something I can help you with. But if you want somebody specifically in Dallas, I just saw the question pop up there. Bitcoin.tax is the only place I know of currently that has a list of people, accountants. You'll find me on there as well. But if you go to Bitcoin.tax and look under there, look for providers. I can't remember what they listed as, but it has people that we're able to. I buy their program to use it for my accounting firm. I'm able to put my profile up there. That's how a lot of people find me. But if you're looking for somebody in the Dallas area, you can check and see if they're there. If not, you can always reach out to me. I'm willing to help you as well.
Fantastic. And that's the other thing I love about Elmer is that if he can't help you, he's going to reach out into his Rolodex, his resources, and he will connect you with somebody that will fit your specific needs. So awesome. Elmer, thank you so much. I appreciate you being on this. And then I'm sure that we will probably end up doing another one of these in the near future. As tax season comes, we just got out of tax season. We're gearing up for next year. Start planning now. Start making those accounting moves now. Start taking accountability of that now, especially if you're investing heavily and are anticipating some decent gains. Make sure you get with your accountant, reach out and connect with Elmer, mitigate your risk so you can start planning accordingly. Because the last thing you want to do is as you're building up speed and momentum in the cryptocurrency space, the last thing you want to do is lose it to fines that or other major problems that could arise because you weren't. Yes, not everyone is past tax season.
That's true. I've got a handful, maybe 10 people that are in extensions. So I'm still dealing with that.
Yep, exactly. So for now, thank you so much. If you have any questions, this video has been on Facebook Live in our three groups, in Seth Manny's group, Cash Crypto group, and Brian Noonan's group. So as well as the cryptocurrency due diligence group. Make sure you join us in each one of those. Lots of great information in all three groups. Reach out to Elmer if you have any questions regarding taxes. Until then, keep on Bitcoining, and we'll see you soon. Make sure you do your due diligence, folks. Bye.
Bye.